what's your worst blow up story and how did you learn about it? This is like one of the biggest mistake we can ruin by emotions and all. So
yeah, it's very much
yeah.
it's very much everything you mentioned there. Okay, it was a big mistake. It was ruled by emotions. I consider myself to be a fairly intelligent guy. Okay, and the big mistake I made was thinking that I was smarter than the market. So my story went as follows. So I started out on the trading floor, running trading cards. I still have a bunch of the trading cards that I have here from years ago that I like to make notes on all the time. So I was running trading cards. I started to advance. I became a clerk. I became a junior analyst. Then I decided I was ready to go trade for myself. Okay, so therein lies the first mistake. The first mistake is thinking that it's a fast process to learn how to trade. What you're doing now, everybody here, and good morning, Michael, by the way, what everybody's doing in here right now is your education and your apprenticeship. Okay, most jobs require that. Okay, essentially you have to learn, and then you have to be an apprentice. You have to learn on the job. And a lot of the times people think trading is just a matter of learning a strategy and then going up and applying that strategy, and it'll be very easy. And it's not. Good morning, Robert. It's a lot more complex than that. You have to actually experience things. So I had raised just short of 9 figures, so just short of $100,000. And I decided it was time for me to go trade for myself. And I lost all of that money inside of 9 months. All right. And the way that I did that was by continually adding to losing trades. And my stance was that the market was wrong and the market was going to realize it and go my way. Okay. Whether the market price action is responding to fundamental news in the way that you think it should or not, the market's never wrong. Wherever the market settles on a given day, on a given week, on a given month, that is where all the price action, trading back and forth for that period of time, decided is the correct price. And I use the word correct deliberately because that is the correct price. Whatever price you think it should be at or you think it's going to is not correct in that moment. So as you lose money and you say, well, I know it's going here, you don't know. Okay? You may have a high probability of it. But even somebody like me who's been doing this for 30 years, my win rate is about 62%. Okay. It's not 100%. It's not even 90%. It's about 62%. And you can make money with a 62% win rate. You can make a lot of money with a 62% win rate if you have the courage to realize when the trade you have set up is somewhere in that 38% range where it's not going to work out. Okay, that's what you have to understand, and that's what I didn't understand, and that's my blow-up story, and my mistake was arrogance. Okay, it was thinking that somehow the market was wrong and I was right. The market is never wrong.
We shouldn't be just focusing on single trades. We should have like huge wide range of portfolio, and it could have like 60% of the win rate. But those 60% can make us win money.
Yeah, it's the overall portfolio you're looking at, Badish. You're not looking at one trade and saying, I'm dumb or I'm smart. And the mistake a lot of traders make is they have a winning trade and they think they're smart. That's not the way it works. Even doctors and surgeons lose patients, right? And still in society, we believe doctors are very smart, but they have patients that die. They have diseases that they can't cure. Sometimes there are things that happen in the markets that you could not foresee. Good morning, Michael, again. And these things take over and they take your trade into the losing zone. I consider the losing zone where your thesis for your trade proves your target to be incorrect. All right, that to me is like the loss zone. And when you're in that zone, you need to swallow your pride and exit that trade. Doesn't mean you can't get back in another one. A lot of traders think they need to focus on one product or one style of trading. I don't agree with that, but I understand why some people do it. So I say focus on one style at a time. All right. And for me, it's a little bit, my average hold time for a trade is 26 days. In a room like this, it might be 26 minutes. That's okay. As long as you learn to exit trades. And I'm going to show you the entire process of me getting into a trade. I'm not going to get into it because it's not triggered yet, but I'm going to show you how I look at an actual trade and how I plan the trade out.
Interesting. Any point or any trade makes you realize that, okay, I need to learn this strategies, approach, all the education I need to get back in your early life? Was there any moment or any crisis or any mistake you made during your trade?
Well, I'll tell you the two biggest changes I made after I blew up that time, which then I never blew up again, was to do something I call real world break even. And what I mean by that is when you take a trade, the first thing you think about, and nobody really does this, is the risk of that trade, not the reward. The risk should come first. Okay. Because once you've gone and said, well, let's see, I'm going to buy this at $5 and I'm going to sell it at $3. $3 is where I'm going to be wrong. Okay. I can accept $2 per share. That's fine. And then you calculate the number of shares you can afford to lose based on the total loss that you're able to stomach, right? And that's decide your share size, okay? And then once you've got that over, now you say, okay, is it reasonable for me to think if I buy something at $3 and I'm going to stop myself out, $5, I'm going to stop myself out at $3, is it reasonable to think I can make more than the $2 I'm going to risk? And if that is reasonable, don't fake it. Actually look at the trade. Whether you look at price action or whether you look at fundamentals, actually look at the trade and say, is it truly reasonable to think that I'm going to make $2 or more for every $2 I risk? Okay. And if you're able to do that, then you could probably take the trade. And the second thing I want to talk about is you need to start to think in percentages. Okay, because if you think in percentages, adding money to your trading account and increasing the size of your trade becomes exponentially easier. And can I show you why that is? All right, I'm going to share my screen and show you why that is. All right, give me a second to. I got to remember how to do this. Okay, here's turn screen share on. And then I am going to put up a window and I'm going to share a particular window. So some of you guys have seen this before, okay? Some of you guys have seen this particular screen before. I'm just going to make sure you guys are seeing it. Yeah, it looks like you guys are seeing it. This is my stock position size calculator. Okay, now I mentioned earlier in the session that you have to go through education and internship, okay? Your investing capital, which is this box I'm circling with my cursor right now, is the amount you're willing to pay for your education and your apprenticeship. So this is one of my actual risk calculators, but I'm going to reduce it to say $5,000 just to make things more simple, okay? Then the percentage of risk per trade, and I go by percentage, not by money. How much per trade are you willing to lose? Not make, right? I already know how much percentage you're willing to make. It's 100% or 1,000% or 10,000%. It's not hard to figure out how much money people are willing to make, right? It's more important for people to understand how much money they're willing to lose. Okay, so how much are you willing to lose? Well, if you say, okay, I'm investing $5,000, well, I don't want to risk $5,000 in one trade because what if I lose it, right? So a comfort zone for a lot of people is 2%. I'm pulling 2% off the internet, okay? 2% is not the number for me, but I'm just going to pull that number off the internet. Okay, a lot of people say you should never risk more than 2% per trade. If I'm being honest, Spottish, I don't know why they pulled 2% out of the air, but let's just use it because that's what a lot of people say. We can talk about it in another session, what the proper risk percentage is, and it has to do with your investing capital and if you're willing to put more investing capital in there. All right, if you're saying for right now it's $5,000, but I have $50 million in the bank, maybe you will change this to 100%. and say, okay, I'm going to start risking 100% per trade. Okay. And now you see the dollar trade per risk is $5,000. But we're not going to do that right now. We're going to stick with 2%. Now, I told you prior to the session starting that I wanted to show you guys an actual trade. So I want to do that really quick. Is that okay?
Please.
All right. So this morning we had news that Disney was going to combine Hulu with Warner Brothers. And they were going to offer a new bundle along with HBO Max, which is now called Max. Okay. Personally, I think that's dumb, but I haven't seen the price point yet. So we'll talk about that another time. So I'm going to show you guys a chart because I only like the Warner Brothers chart here. Okay. I'm going to connect this session. I'm assuming you can see this Warner Brothers chart right now. Is that correct?
See if our attendees also, please let us know.
All right. So this is the Warner Brothers chart. And what we have on the Warner Brothers chart is we have a double bottom. Okay. And we have a bottom here and we have another bottom here. Now I have a way of deciding whether it's a high probability double bottom or not. Okay. Because again, people have to understand the double bottoms and double tops. There's a lot of rules that go into those actually being patterns. All right. And this one fits the rules. And again, we could talk about that in another session. I believe I actually mentioned that in a previous session. So if you can go to the TradeZero archives and find that, I would recommend that you do. But basically a double bottom, you're able to measure the targets off of the double bottom. All right. And what you want is the 75% extension of the move from this peak to this low, and then the 100% extension of the same move. So a doubling of this distance. Now I have a tool here that I can use. You can do this manually, but if I measure out the move from here to here, okay, here's the 175% move, takes me to 886, and the 200% move takes me to 905, which is 100% of this move. Now, the reason I said I can't take this trade yet is because I need the market to close above this peak. Okay, and this peak comes in at $8.28. All right, so I'm going to start planning out a trade entry. Okay, so I'm going to say, okay, if I get a close above 828, I want to get in somewhere around 828. All right, so just for the purposes of planning this trade out, I'm going to go with 830, okay, as my entry. Now I'm going to explain this all out before I show you on the position size calculator again how this would work. All right. The second thing I need to know is what is my loss area, or what's the price where I know my trade is no longer going to work. And for me, it's a 37.5% retracement of this particular move. So if we start to move up and then start to come back down and we break this red line here, which is where the 37.5% is, I want to be out below that. That level is 781. I'm going to go ahead and pick 776. All right, because it's below that number. Doesn't matter where we do it because I'm just showing you guys an example. I will talk about targets in a minute. So now I'm going to start sharing. I'm going to stop sharing this and I'm going to go back to sharing what I was sharing before, which is the position size calculator. All right. Pull up my window. All right. So here I've already got the ticker symbol in. It's WBD, Warner Brothers Discovery is the name of the company. I already said that my entry price, which you could see here at row 9, is going to be about $8.30. Now that might change, okay, but that's what I'm going to use to start planning this trade out. Then where is my stop price? I said my stop price is going to be about 776. Okay. That gives me 54 cents of risk per share. Okay. Now my maximum risk is $100, 2% of my investing capital, which is $5,000. My max risk per trade is $100. My position size is going to be 185 shares. Why? Because if I get stopped out at 776 after an entry of 830 on 185 shares, I'm going to lose $99.90, which is inside of that max risk per trade, that $100. 2% of 5,000 is $100. If I get stopped out on this trade, $99.90. So what happens if I add one share to that? I say, I'm going to do 186 shares. Well, now I'm above $100, right? Because I'm $99.90 plus an additional 54 cents, which takes me to $100.44. That is breaking my rule. That is taking me above 2% risk per trade to $100.44. So I can't do that. So I'm going to buy 185 shares of that. Okay. Now, why does this matter on a percentage basis? Why does this prove that percentage is more important than dollars? Well, let's say I have a bunch of winning trades. I'm doing really well, and I get my $5,000 up to $80,000. Okay. It's a big number. I understand. Now look at my risk per trade in terms of dollars. It's $1,600. My position size goes up to 2,962 shares in order to only have an actual risk of 1,599.48. For a lot of people, this $1,600 of risk is going to be too much because maybe their mortgage is $1,600 or their rent is $1,600, right? But for me, it's still just 2%. It's only 2%. Now, what also happens if maybe that first trade loses money, right? And I end up losing the $100, and now I only have $4,900, right? Now my risk per trade has gone down to $98, but it's still 2%. It's always the same. So if I were to jack this back up to $100, if I wasn't using percentages, I would now be using too much risk for the investing capital that I have. What if it goes down to $900? Oops, that's the wrong box. What if it goes to $900 in my investing capital? I had a really bad losing streak. Now from 165 shares, or 185 shares rather, I'm going to 33 shares, which you can see in row 14 here. Still the exact same trade. Still 2% risk, but only $18 of risk. Now, some of you might be saying, well, what am I going to do with $18? You're going to build your account back up in the way that a professional does. Okay? That's what you're doing. And you're sticking to 2%. So if somebody says to you, what do you risk per trade? 2%. Well, how much money is that? You say to them, I don't care. It's 2%. That's what I risk. Well, how many shares do you buy? 100, 200, 500? Well, I don't know. What's my entry price and what's my stop price? And I'll tell you how many shares I'm going to buy. Because you're always going to stay in that 2% risk per trade. 2% risk, whether you're doing $5,000 or whether you're doing $500,000, still 2%. And this number stops bothering you. The amount you're going to lose stops bothering you when you train your mind to look at percentages rather than dollar amounts. Now, I also use this, by the way, just as a point of information here. I always use this to also calculate out my reward. But what you do with that is just kind of use it in the opposite. So my entry level is 830 and my stop price is 776. Well, the first target is going to be 886 for me. So if I put in 886, okay, it drops me down to 178 shares. But you can flip these numbers and figure out your target. One thing I know for sure is my risk is 56 cents at my first target. What was it in my stop? 54 cents. So I already know my reward to risk based on my first target is better. It's better than 1-to-1. So I know I can take this trade. My second target on this particular trade is $9.05, 75 cents versus a risk of 54 cents. So I already know I'm past my required 1-to-1 ratio. And I don't look at the dollar amounts. I don't. I just make sure I'm better than 1-to-1 because I have a 62% win rate. And I make sure I never exceed my percentage risk. Okay, and as I already told you guys, I meant to clear this out, but you've already seen this. So this is where one of my accounts are. Some people might say $2,175, that's too much risk per trade. It's 2%. It's only 2%. If I take a trade with $108,725 in my account, and you take a trade with $5,000, and we both do 2% risk, we're doing the exact same trade. It is literally the exact same trade. There's no difference. So this is what I try to tell people. If you think in percentages, my account is the exact same as yours. If you think in percentages, you can do the exact same trade I'm doing if I were to ever show you a trade. And by the way, I need to stress, I am not in this trade because we have not closed above the double bottom threshold, which is that high of 828. If we close above that, now I start measuring the risk to reward and I see if the trade's appropriate. And if it is, I get in it. If the market runs above that level, I have to wait for a pullback to get into it. I will not get into a trade that is not at least 1-to-1 reward to risk or better. I won't do it. So if it runs away, no problem, not my trade. It has nothing to do with me, right? It's just not my trade. It's a trade. I was looking at the setup. Setup didn't work. Don't care. I don't look at the chart again. A lot of people will go back and say, oh, I missed that one. Look how high it's going. You didn't miss it. It wasn't yours. It wasn't yours. Okay? Only the trades that are yours. And obviously by this, I'm talking about mine, right? If you're only looking at it through the lens of the trades that are yours, if this runs through my entry level, you won't see me open up a Warner Brothers Discovery chart for probably another 2 or 3 months, or if I have some other reason to do it. I don't even look at it. Because why do I want that to worm into my brain that if I just would have been stupid, I could have made money?
I can really understand how you set your mind, prevent those kind of emotional up and downs. Just focus on percentage, no matter how much money you trade. Just focus on have your rules set it up, have your strategy set it up, and follow them. And so in this way, you have your own psychology. Nothing gonna change. And
nothing outside of you is going to change that psychology. By the way, this is one of my favorite comments. Michael, who accidentally logged into the wrong session, said, wow, awesome info. That makes me really happy because this is something that professional traders have known forever. And it is not something that retail traders can't do. A lot of things professional traders do, you can't do. You can't call your friend at Lloyd's of London or your friend at Waterside Hedge Fund and find out what's going on behind you can't do that. But you can think in percentages. And that is the first step to becoming a professional trader. Okay, because you're able to, doesn't matter what your account is. Makes no difference. You can have a $100 account or a $100,000 account. And if you think in percentages, you are equal to the person with a $100,000 account. It's very similar to like if you ever watch, and I mentioned to you in a conversation earlier, I'm going to be on Fox Business News today at, I think, 12:45 Eastern time with Neil Cavuto. And they will ask, they're not going to ask me this question. The reason I looked at Warner Brothers, that's what they're asking me about, if I like this combination today between Warner Brothers, Max, and Disney and Hulu. And I don't, but that's not important. When they talk to a hedge fund, the first thing they'll say is, you're up 33% this year. They don't say you're up 33 million or 3,300 or 33 billion or 3.3 billion. They say you're up 33%. Pick up on these things, guys. These are things you can just latch onto, and it'll be the best thing you've ever done, because all of a sudden losing 2% doesn't bother you. And here's why it impacts your psychology in the way that you mentioned, Marish. When your account starts growing, your mortgage will probably stay the same. Your car payment will probably stay the same. The amount you spend on food in your house, maybe not at restaurants, but in your house, will stay the same. So when you put on your first $1,000 or $2,000 or $3,000 risk trade, your first thought is, oh my God, that's a lot of money. But it's still 2%, or it's still 5%, or it's still 1%.